Hello and welcome back to the next of our sessions. This question is June 13, question 1 for ACCA P2. It's a group statement of financial position and we need to be really careful to follow our set procedure for a group statement of financial position. So what I'm going to do is take you through it note by note, working by working, to identify the key aspects and to make sure that we build our answer up and maximize the marks possible. Now remember that for the statement of financial positions, you will find that the first few notes relate to the group workings. The rest of the notes will relate to IFRS adjustments. So what that means is in the exam you can go straight into your working one for the group structure. You don't need to read through all the rest of the workings, etc. In fact, it's just a waste of time to do so. So as soon as you see that it is a group statement of financial position, you're bang into working one for your group structure. That will always be in notes 1, 2 and 3, maybe 4, but usually notes 1, 2 and 3. The important things to note in your group structure are the dates, the amounts and the percentages. So it's really important. I cannot stress it enough how important it is to post all of that into your working one group structure. So before I even start, I identify who the parent is here, and that's trailer. And I also identify the date we're working up to. So we're working up to the statement of financial position date on the 31st of the 5th, 13. So now we can go through the notes, and in these notes I'm looking for the dates, the amount purchased and the consideration paid for that. The dates being mostly the thing that I'm looking at here. So the first investment on the 1st of June 11, trailer acquired 14% of Collar. So trailer invested in Collar. Remember, trailer is the parent. They did it on the 1st of the 6th, 11. They bought 14% and they paid $260. All of that is important. You must note it all. We're also told that Park, who we haven't talked about yet, so Park acquired 70% of Collar. So they acquired 70% of Collar on the 1st of the 6th, 11, and that cost 1270. Now look at the group structure as it is now. As it is now, all we have, because remember we do this from the point of view of the parent, and all we have from the point of view of the parent is an investment in Collar, 14% of Collar. We haven't yet invested in Park. So Park's interest in Collar is nothing to do with the group at this point. So Collar at this point is just a simple investment because the only part that's anything to do with our group is the 14% that Trailer, our parent, holds. Now we're told more information about the net assets, etc. We'll use that in our working 2. So let's skip to note 2 where we're told on the 1st of June 12, Trailer acquired 60% of Park. Now, when that happens, when Trailer invests in Park on the 1st of June 12, that means that both Park and Collar come into our group because Park we own 60% of, so that's going to make Park a subsidiary. So we paid 1250 for that. And now Collar, that used to be a simple investment with 14%, becomes a subsidiary because Park holds a controlling interest in Collar. So through Park we have a controlling interest. Trailer has a controlling interest. So what that means is Collar has gone from an investment to a subsidiary, which is a step acquisition. And note the acquisition date is the 1st of the 6th, 12, because we didn't have an interest in Park until that date. So that meant the only interest we had in Collar was our own, the 14%. So it was a simple investment until we made that investment in Park, which made it a subsidiary. So we now have a subsidiary in Park and a subsidiary in Collar, and we need to deal with the step acquisition, noting that the date of acquisition was on that investment in Park on the 1st of June 12. You can see how important it is to note all of that because it determines what treatment we're going to do in the rest of our group workings. Other things I like to do in our working one is to identify the percentages. The more complicated one first. So the interest in Collar by the year end, well, we have a direct interest of 14%. We also have an indirect interest through Park. So multiplying the two percentages together, 60% times 70% gives us 42%, which means the effective interest of the parent is 56%. That gives us an effective NCI of 44%. So when we split the post-acquisition profit, those are the percentages we will use for Collar. Don't forget, if you've got a mixed group, you need to split the direct and indirect interest. It's easy for Park because it's simply 60% to the parent, 40% to the NCI. And the last item I like to deal with in my working one is the indirect holding adjustment. If you've identified that there is an indirect investment, and that will be Park's investment in Collar, well, that means we need to do our indirect holding adjustment. The indirect investment is the 1270 investment by Park in Collar, because that wasn't made by the parent, it was made by the subsidiary. So some of it will relate to the parent, some will relate to the NCI. So we multiply by the NCI percentage in Park and make sure it's the NCI percentage in Park that you use. And that gives us an indirect holding adjustment of 508. Now that 508 will go to reduce our cost of investment in the working three for Collar. So in our Goodwill working for Collar, we'll reduce our cost of investment by 508. And also that will go to the NCI working. It will reduce the NCI in Park by 508 also. So those are the important things to deal with in working one. Set out your dates, the amounts that were paid. Also identify if there's been a step acquisition or sale of shares or something along those lines. Then set out your percentage interests. And if there's an indirect holding adjustment required, do it at this point. Okay, so this sets the scene for the rest of the workings we're going to do, and we should be able to do them more straightforwardly because we've identified all of these things. So let's move on to working two. For working two, we'll need some of this information, and the key thing to remember on working two, which is your equity table. For P2 questions, fill in the things you do know, and that will be given to you in the question and in the notes, and that will lead you to the things you don't. So you've got to have a set way to approach this, and the way to approach it is you fill in the things you do know from the question, and that will lead you to the things you don't. Now we're going to start with the equity table in Park. So what do we know about Park? Well, we know that by the year end, their equity figures are this: share capital 1210, retained earnings 930, other components of equity 80. We also know that at acquisition, we have net assets in total of 1950. So that means column 1 in our table should add up to 1950. Retained earnings of 650 and other components of equity 55. The share capital never changes, so we know that that will be 1210 as well. So we know all of those at acquisition and at the year end. the share capital, retained earnings, and other components of equity. We also know the net assets at acquisition should add up to 1950. And if they don't, the excess is due to non-depreciable land. So everything is given to you here to fill in your working to. So filling those details in for Park, at acquisition and at the year end, I'm also going to have a column for the movement. I'll talk about that in a second. So for share capital, 1210 at acquisition, 1210 at the year end. We can see it's 930 at the year end, and we're told it was 650 at acquisition. Also, for other components of equity, we can see it's 80 by the year end, and we're told it was 55 at acquisition. Now, we're told the acquisition amount should add up to 1950. 1210 plus 650 plus 55 doesn't add up to 1950. We need another 35. That is the fair value adjustment on non-depreciable land. So it's 35, that makes it add up to 1950, which, adding the fair value adjustment into the year-end figures, gives us 2255. Now, just on the movement, remember that we're splitting out the movement between retained earnings and other reserves. So the total movement will be 305. So that's the total gains and losses in the year, which we'll separate out between the parent and the NCI. But for our statement of financial position, we'll need to show separately for the group the retained earnings and the other reserves. So we need to know the movement on each of those separately so we can bring it in separately. So that's why we have that movement column. Now, we can do exactly the same here for collar. We do need to be careful though about our dates. It's okay for the year end. We can see at the year end, these were the figures for collar. Share capital 800, retained earnings 350, other components of equity 950, but we're given the net assets at the 1st of June 11 and at the 1st of June 12. So you need to think which of those you're going to use. Now you shouldn't have to think too long because we identified in our working one that we didn't get control of collar until the second investment in Park. So it was on the second investment on the 1st of June 12 that we got control of collar. We always get our net assets on the acquisition date where we got control, which will be on the 1st of June 12. So that's why we're going to use the 1150, the 240 and the 70. So once again, we're told that the excess is due to non-depreciable land. So we can do exactly the same for collar. We have the at acquisition and at year end figures. For share capital, 800 doesn't change. Retained earnings, we can see by the year end are 350 and we're told at acquisition they were 240. Same for the other components of equity. They were 95 by the year end. They were 70 at acquisition. That at acquisition should all add up to 1150. It doesn't. We need an extra 40, which is the excess due to non-depreciable land. 1150, it adds up now. The year end is 1285 with the movement in total 135 and splitting it out between retained earnings movement 110 and other reserves 25. So it's really important that you learn how to do that. It's basically the same in every question. You fill in what you do know, that will lead you to what you don't. You will always know the year-end figures. You will always know the acquisition figures. You'll usually know what it should add up to at acquisition, with a balancing figure being a fair value adjustment. Sometimes there's other adjustments in there, but mostly this will be it. The movement then, don't forget to split it out between the retained earnings and other reserves. Okay, so we're at working 2. Let's move on to working 3. And we're going to need one for each of Park and collar. because we've got two subsidiaries. So we need to add in note 3 here, because in note 3 we can see that there's been an impairment test. There's also no impairment relating to caller, so this impairment will relate to Park, and they give us a recoverable amount. Now there's some important stuff we need to note here. Number 1, for Park, we are told that they choose to measure the non-controlling interest at acquisition at its proportionate share of the fair value of net assets. So that's in note 2, the second paragraph in note 2. That means we're doing proportionate goodwill for Park, and you need to be careful to do that. It also means that the impairment test is going to be a little bit trickier. So we'll talk about that when we get there. But let's work out the goodwill first of all. So the goodwill in Park. Well, we noted in working 1 that the cost of investment was $12.50. This is proportionate goodwill, so we measure the NCI at their proportion of the net assets at acquisition. Well, we're actually told the net assets at acquisition in Park were $19.50. So 40% of 1950 gives us 780. Take away the full 1950 and that gives us goodwill for Park of 80. Now, it's goodwill all relating to the parent because it is proportionate goodwill, not gross goodwill. So that has implications for our impairment. We mentioned before that basically if we've got proportionate goodwill, what we do is we pretend that there is goodwill allocated to the NCI when there is not. How do we do that? We do it by grossing up the goodwill. So the goodwill is 80 and we gross it up by multiplying by 100 over the parent's percentage. The parent's percentage is 60. 100 over 60 times 80 gives us 133.3. So that's giving the NCI notional goodwill. So the notional goodwill will be the difference between the 80 and the 133. So basically what we've done here is added 53.3 of imaginary goodwill for the NCI. Now we only do this for the impairment test. And remember, the impairment test is to add the goodwill, and in this case the grossed up goodwill, to the net assets in the subsidiary. And this will always be done at the year end. So the net assets at the year end for Park were 2255 from our equity table. And that gives us the carrying value of the subsidiary. So the grossed up goodwill plus the net assets gives us the carrying value of the subsidiary. We are told that the recoverable amount is 2088. So the carrying value compared to the recoverable amount, well, we can immediately see that it's overvalued. So we're going to have to impair it. So we've got an impairment of 300.3. So far, so good. Nothing different to what we'll have done previously. But do you know what? There'll always be something in a P2 question that's a little bit tricky. So you could pass this question by getting to this point. But there's a little bit of a catch here because we can see that the goodwill is 80. But we've got an impairment of 300.3. We also remember that we've added some notional goodwill in here. So the first thing to do is to take the notional goodwill out. So the notional goodwill was 53.3. We need to subtract that out. That's because this impairment is going to come to more than the goodwill in total to the parent. So we've only an impairment of 247 to allocate. And we're told that any of this in excess of the goodwill relates to property, plant and equipment. So the final line of note 3 says any impairment loss has been determined to relate to goodwill and property, plant and equipment. So once we remove the notional goodwill, we've got 247 to allocate, and it's going to go first of all to Goodwill. So we remove the Goodwill, and remember that all relates to the parent. So that will go to working 5. No need to split it between the parent and the NCI. However, the rest of the impairment will need to go to property, plant and equipment, and that is owned by the parent and the NCI. So the remaining impairment goes to property, plant and equipment, and we need to split that between the NCI and the parent. Because although the NCI doesn't own any of the goodwill, it was all relating to the parent, it does own some of the property, plant and equipment. So the remaining impairment needs to be split between the parent and the NCI. Now that's a little bit tricky, but you just need to go through it step by step. If you didn't get all of this in the exam, it wouldn't be the end of the world. You would still pick up most of your marks. So what you've got to do is stick to the basics, get the basic bits right, and try your best for the other bits. You may not get it all, but we're looking at how to get 100% here. You're not asked to get 100% in the exam, so accept that some of it you won't get in full, but this would be the correct treatment. Okay, so we can now move on to the goodwill in our second subsidiary, which is Collar. And we need some more information, so I've included it in here. Again, for Collar, we're going to calculate proportionate goodwill, but we need to remember here that for our working 3 in Collar, there is a step acquisition to deal with. We identified that in working 1. So remember, the first step in a step acquisition is to revalue the original investment to fair value. So the original investment cost us 260. We're told that in note 1. But we're also told in the second paragraph of note 1 that the fair value of the 14% holding was 280 on the date of acquisition. Remember, that's the date of the second investment. So that means we've got a gain on acquisition of 20. However, there's a little bit of a quirk in here because we're also told in the rest of note 1 that it's now worth 310. So I'm going to tell you that this gain of 20 has already been recognised, and that's in Trailer's own financial statements, because what they've done is they've revalued Collar in their financial statements. They've brought it in at cost of 260, but we can see by looking up at the assets of Trailer that they currently have it in at 310. That's a revaluation up from 260 to 310 of 50. Now, in actual fact, we only want to, in the group accounts, recognise a gain of 20, whereas they have recognised a gain of 50. So in actual fact, when we get to our working 5, we would usually have brought in the gain of 20, but we're going to have to remove some of the 50 to get it down to 20. So we'll remove 30 of that gain on revaluation to get down to the 20. Now, once again, if you hadn't noticed that and you just worked out the gain on acquisition of 20, you'll lose some marks, but not all. You'll still get marks for the calculation. But we need to recognise that they have already revalued it in their own financial statements. So Trailer has revalued it from 260 to 310. That's too much. That's 50. We only want to recognise a gain of 20 in the group accounts. So we need to strip out 30 of the 50 gain. Okay, so we can now work out the goodwill. And don't forget, we've got to bring in the fair value of our acquisition. So the fair value of the original investment is now 280. We bring that in. That's step 2 of our step acquisition. We also have the cost of the second investment, which was 1270. So that was the cost of Park's investment. But remember, we have an indirect holding adjustment to bring in here as well. We calculated it in working one, the 1270 times the NCI percentage in Park, and it was 508. So you need to remember to do all of those items when you're working out this goodwill. That gives us 1042 for the total investment. It's proportionate goodwill, so the NCI percentage we worked out in working one as 44% for Collar, times the net assets at acquisition 1150 gives us our goodwill once we take out the total net assets of 398. So there's a few things to do here. It's a step acquisition, so we need to revalue the original investment to fair value. The gain will go to working 5. The goodwill then needs to include the fair value of the original investment plus the cost of the new investment, less the indirect holding adjustment to get us the total consideration. It's proportionate goodwill, so we bring in the NCI percentage of the net assets at acquisition, take them out in full, and that gives us the goodwill of 398. Okay, we can now move on to our NCI, and really that's all the tricky bits of the group done. The NCI is just bringing in the bits and pieces that we usually do, but remembering to do it for both Park and Collar. So Park's NCI at acquisition we worked out in working 3 at 780. Their percentage of the post-acquisition profit, so in working 2, the total gains and losses in the year were 305 for Park, times the NCI percentage is 122. Their share of the impairment of property, plant and equipment we worked out in working 3 was 66.8, and the indirect holding adjustment was 508. For Collar then we have the NCI at acquisition we worked out in working 3 as 506, plus their share of post-acquisition profit, and remember that's all the gains and losses from working 2 times the NCI percentage, so that's 59.4. Add that up and we get 892.6. So there's nothing tricky in there really. We just need to bring in all the correct figures. So if you're not sure where any of those come from, go back and check them. Working 3 for our NCI at acquisition for both. The share of profit is always the share of the total gains and losses in the year from working 2. And just check your NCI percentages to working 1. Okay, so we're now able to pull together our retained earnings and other reserves. So retained earnings and other reserves or other equity, I'm going to split out. So I'm going to show reserves and other equity separately but in the same working just to make it quicker. The parent's reserves are 1240. The parent's other equity is 125. Now I need some calculations because we need to get the parent's percentage of both subsidiaries, reserves and other equity. So starting with Park. Park's parent share of post-acquisition reserves, first of all, is 280 times 60%. So when we did our equity table, we split out the movement between our retained earnings and other reserves. Looking at Park, we can see retained earnings of 280, other reserves of 25. The 305 we've already used a total for our NCI, but we need to split out the retained earnings and other reserves. So that's what we're doing. And then we'll do the same for Collar because we split out our movement here. We had 110 and 25. So we need to get the parent's percentage of each of those to bring them in. So we can see that we're bringing in the 280 times the parent's percentage for retained earnings of Park. and the 25 times the parent's percentage for the other equity of Park. So that's the split that we got in working 2. We do the same for Caller. We had 110 retained earnings, 25 other equity movement, and we take the 56% parent share of it. Remember, that's the effective interest we worked out in our working 1. Then all of our adjustments that we've done so far will either hit retained earnings or other equity. So for example, the impairment of Goodwill, well, that hits the P&L, so we'll go to retained earnings. Also, the impairment of property, plant and equipment is 100.2. That will hit retained earnings. And the other side of it, remember we had in our NCI working. Then we removed the gain on Caller's investment. Remember we said that we wanted to bring a gain of 20 in for the step acquisition, but they already had a gain of 50. We need to remove 30 of it to get it down to the 20. So that's what I'm doing there. That's to bring in the gain on the step acquisition of 20. I'm actually removing some of the 50 gain that they already recognised. Now, that's all of our workings for the group done. What we do now is we go on and we look at each of the other notes, and we do a working for each of the other notes, and those workings will give us movement to go into either reserves, retained earnings, or other equity. So we will have future adjustments to make in here. But in the exam, what you do is you get this far, leave this working open, don't balance it off as yet, and then move on to your other notes, because your other notes will have things to come in here. Once you've done your other notes, you can add this up, finish it off, and prepare the statement of financial position. So remember, we always look at these as really being 2 questions. It's a group first, and then some IFRS adjustments. And we're going to look at the IFRS adjustments now. Looking then at note 4. Now, this was a tricky one, and I really wouldn't have expected a lot of students to do the correct treatment for this. But you've got to recognise that the examiner expects that. So you need to make an attempt at this and just see what you make of it. Do your best. Do what you expect to see in the financial statements, given what you're told. So we're told that they've made this 50 million loan a year ago. So that's going to be a financial asset to them because the charitable organisation will pay them interest on it. It's going to be paid at 3%, but if it was unsubsidised, it would have been 6%. Now, what that means is that Trailer has effectively locked itself into a lower interest rate. So we will have to assess as to whether this bond has been, or this loan has been impaired at inception. And it really will have been, because they could have got 6%, so we'll need to discount it at that. But they're only getting 3%. So really it's really an impairment, because they'll get less for it than they could have. Now, what they have done, just to show you so far, is that they have recorded the cash entries for the loan. So they have brought in the 50 million, and the cash then has been credited off the loan and debited to cash received. So they've debited cash received, credited the bond to leave us with a balance of 48.5. That's what they've done at the minute. That's not correct. So what they should be doing is, at inception, they should be seeing what the present value of the future cash flows on the loan would be at the unsubsidised rate of 6%. So they'd need to take the interest and the capital discounted at 6%. So starting year 1 interest discounted at 6%, 1 over 1 plus the discount rate to the power of 1 year will give us 1.41. Year 2 interest, 1.5 discounted at 6% for 2 years, is 1.34. And year 3, well, it's a 3-year loan, so we'll get the capital back and the interest in year 3, 51.5, so 50 capital plus 1.5 interest, discounted at 6% for 3 years, gives us 43.26. So the present value of the future cash flows we expect on this loan are 46.01. So that's the value that the bond should have come in at inception. That effectively is the fair value of the bond at inception. Now that can be confusing because usually the fair value of it is the amount you forwarded in cash. That will be the asset to you. You've loaned it to someone else. It's an asset to you. It will be usually at the 50 million you forwarded. But because we're locked into this low interest rate, actually the fair value at inception was 46.01, which means that there's an impairment of the difference between the fair value and the 50 we forwarded, which is 3.99. We need to take that to working 5 as an adjustment to retained earnings. So that's where we have it. We have the fair value at inception of 46.01. That was 1 year ago. So what is the correct amortized cost treatment for this? It's only year 1 we need, and we know the opening balance was 46.01. The effective interest is at 6% of that, which is 2.76. The cash was 1.5, giving us a closing balance of 47.27 on the bond. So we need an interest charge to working 5 of 2.76, and we need an interest charge to the bond, which we've just done, of 2.76 to get it to that amount. So we'll need to adjust the statement of financial position to reflect that closing balance, and we'll need to take the correct interest to working 5. Now, once again, that was a tricky one. Don't spend too long. If you don't know how to do it, have a go and then move on. Do not waste time. There'll only be a few marks for it. Do your best and then move on to the next bit, because if there's a difficult one in there like this, there'll also be easier ones to deal with. So you need to recognize that and leave yourself time to have a go at the easier ones. Like, for example, the next, which is office accommodation, which was bought for 90 million. Then we had an impairment because it fell in value in the first year to 75. But then it came back again. So what are we trying to test here? What we're trying to do is we're trying to see, can you deal with a situation where there's been an impairment which has reduced the value of the building, then it's been reinstated, the impairment has been reversed. Now, you need to know that you can only reverse an impairment up to what the historic cost would have been had no impairment taken place. So we need to keep track of both the historic cost and the revalued amount in order to do that. So that's what the examiner's trying to test here. So let's do it. This is working 7 for this revaluation. Now the cost of the building was 90. So in historic cost we have 90. We bought it in 1st of June 11. So we've had 1 year's depreciation with a 30-year useful economic life. So that gives us depreciation to the 31st of May 12 of 3. So when we had the revaluation or impairment down to 75, we had a carrying value of 87. So the impairment will be from 87 down to the carrying value of 75, as it will be from here on. So that's going to be an impairment of 12. So last year we had an impairment of 12 down from the 87 carrying value to the 75. Now we need to keep track of what the depreciation would have been on historic cost and what it was on the revalued amount. On historic cost, it will remain at 3. On the revalued amount, it will be 75 over the remaining useful economic life of 29. So the carrying value on historic cost would have been 84, but it is 72.41 at the 31st of May 13. And now we're told they should be revalued up to 105. So the revaluation up to 105 would create a total revaluation of 32.59. Okay, so we've got a total revaluation of 32.59. And the point I was making earlier was if there's been a previous revaluation down, we need to reverse that impairment, but only up to the historic cost as it would have been. So that's up to the 84. So up to 84 will go to the P&L to reverse the impairment that we had previously. The rest of it will create a revaluation reserve. So that's the point we're trying to make here, is that if you've got a reversal of an impairment, you reverse it through the P&L up to the historic cost as it would have been if the impairment didn't occur. The rest will create a revaluation reserve as per usual. I'm just going to note here as well what the property, plant and equipment in the statement of financial position will be. We have trailers amount 1440, park 110, collar 1300, just to bring in some of the adjustments we've done. The fair value adjustments in working 2 were 35 and 40. The impairment of the property, plant and equipment for park in working 3 was 167. And now we have the revaluation of the offices, bringing it up by 32.59. So the total for the statement of financial position for property, plant and equipment will be 3780.59. Now you could have done all that on the face of your answer in the statement of financial position, but I'm just noting it here so that we can just bring in that one figure when we get there. Okay, so that's note 5, and we also know what our property, plant and equipment will be in the statement of financial position. Let's move on to note 6. We've got 2 major restructuring plans here. The first plan is to reduce its capacity by the closure of some smaller factories which have already been identified. Now, as soon as I see restructuring plan, I think I'm probably going to be tested here on whether I can recognise a provision for this or not. What do I need for a provision? I need there to be a valid expectation created by some sort of announcement to the employees, etc. And I need a plan that's not going to change, to be ready to go and set in stone. And that all needs to be by the year-end date. So we're told that there will be redundancies, and they've been selected and communicated with. So that's the first bit, valid expectation. The cost is 9 million, 4 million remaining costs and 5 million in termination costs. The second plan is to reorganise the Finance and Information Technology Department over a 1-year period, but doesn't commence for 2 years. Well, I immediately know I can't provide for that because it's not happening for 2 years. So that means I can start to answer this. So we are going to provide for the necessary costs in the reorganisation for the first one. So we'll provide for the 9 million in redundancy costs, 5 million in the lease termination costs, but the 4 million in retraining is an ongoing cost. You cannot provide for ongoing costs. So we won't actually provide for the 4. So we'll just provide for the 9 plus the 5. And as I said, no valid expectation for the second plan, and it's in 2 years' time, so no provision. Didn't even have to think about the valid expectation because once I knew it's 2 years away, I knew we're not going to create a provision. Okay, so we'll bring in that 14 million provision. I'll show you where all this will go in working 5 at the end of the notes, but we want to get all the treatments first and then we'll bring it all into working 5. The last note then is a pension plan. So all we need to do for this pension plan is follow our set procedure for pensions. So if you've done our lecture, you'll know it's Paul the pensioner. You need your 4 T accounts, profit and loss, assets, unrecognised amount, liabilities. We need to post in all the movements we're given here, and that will give us the amounts we need. And we're looking for the amounts to go to, we're told the above figures have not been taken into account except the contributions. So we need to bring in our P&L charge and our statement of comprehensive income charge. Those will both go to working 5. So the first step in this is always to calculate the return on assets and the interest cost. So the return on assets will be the opening balance on the assets times the discount rate, which is 5%. So that's 5% on 28. So that's 1.4. Our interest cost is the unwinding of the discount on our pension liabilities, and that's 5% of the opening liabilities. So 5% of 30, which gives us 1.5. Now, set up your table for working 9, which is our pensions. It's Paul the pensioner, P-A-U-L, P&L, assets, unrecognised liabilities. We can bring in the brought forward amounts, which are 28 for the assets, 30 for the liabilities. Remember, we post these in as a debit being positive, a credit being negative. And we just need to post in all the amounts we're told about here. And remember, we've got a way to remember all of these, which is biscuit. So B-I-S-C-U-I-T. B is for the benefits. I is for the interest cost or the increase in assets. S is for the service costs. C is for the contributions. U is for the unrecognised amount, which will be the balancing figure. And the other I is for either the interest costs or the increase in assets, whichever one you didn't put in for the other I. The T of biscuit is for the total at the bottom. So you need to remember what way round these go. Benefits paid, we're told, are 3, which will be reduce both actually. Reduce the liabilities and reduce the assets. So debit the liabilities, credit the assets. I'll put in my interest costs here. So I is for the interest costs of 1.5. Those will increase our liabilities because we're unwinding the discount on the liabilities, so that will increase them. And the charge will go to the P&L. The service costs are credited to the liabilities because it's increased services for the year, which will increase the liabilities, and debited to the P&L. Contributions, we're told, were 2. They're the only one-sided entry. We're told they've already done the other side, the cash. So debit the assets because we've contributed more to increase the assets. Credit cash. The unrecognised amount is the balancing figures. I'll come back to those in a second. And the increase in assets is debited to the assets, credited to the P&L. The T is for the total at the year end. We add up the P&L. We're given the final balance on the assets of 29. We add up the unrecognised amount, and we're given the liabilities of 35 at the year end. Remember those unrecognised amounts? Well, that's the balancing figure. So we've got assets of 28. So 28 less 3 plus 2 plus 1.4, which is all our postings, does not equal 29. The difference is the 0.6. And the 0.6 will be a debit to the assets, a credit to the unrecognised amount. That's the statement of comprehensive income amount. For the liabilities, minus 30 plus 3 less 1.5 less 1 does not equal 35. We need more credit of 5.5. So if we credit 5.5 to the liabilities, we debit 5.5 to the unrecognised amount. So that means the balance on the unrecognised is 0.6 of a credit, 5.5 of a debit. The net amount is 4.9 of a debit. So it's the balancing figures when you come to that. If you're not sure of any of this, go back over our session on pensions, because we go through in detail how to do each part of this, how to remember it, and it's really easy if you do that. So if you're not sure of any of this, go back and recap that session. So what do we need from this? We need the P&L charge, which will go to our working 5 retained earnings, and the unrecognised amount of 4.9 will go to other equity. And don't forget, we'll have a net pension liability of 6. So that needs to go on our statement of financial position. Okay, now that we've done all of our notes, let's go back and fill all of the amounts into working 5 to finish it off and get our retained earnings and other equity. So this is where we were for our retained earnings and other equity. What we need to do now is bring in the other adjustments we made in our notes. For example, the impairment of the bond at inception was 3.99. The interest on the bond was 2.76. So that was, remember, the subsidised bond treatment. We had a property, plant and equipment revaluation in working 7. 11.59 of it was to hit the P&L or retained earnings. The other 21 creates a revaluation reserve in other equity. The provision we said was 14, so that will go to retained earnings. And lastly, the pension, we said 1.1 of it will hit retained earnings. The other 4.9 goes to other comprehensive income in equity. So that gives us 1254.7 for retained earnings and 170.1 for other equity for the group. So we can bring those figures into our statement of financial position. Remember, the way to do this is to do all 5 of your group workings, leave working 5 open, do your other notes and bring those adjustments into working 5 before closing it off and preparing your statement of financial position. So for the statement of financial position, we've done most of the things we need. We've got trailer park and collar and some adjustments. For non-current assets, goodwill from working 3, well, there was only goodwill left in collar. For park, it was all impaired away. So that was 398. Property, plant and equipment, we noted in working 7, it would be 3780.6. And our financial assets, we add them across, and don't forget the treatment on the charitable loan. So add in 2.76 of interest less the 3.99 of our impairment. Current assets, just add them across, which gives us 6385.4. Equity, use the parent only, 1750. Retained earnings, we did in working 5 as we did with other equity. We had an NCI in working 4 of 892.6. We also have non-current liabilities, add across, plus the pension liability from working 9. And current liabilities, add across, plus the provision from working 8. And that gives us 6385.4. So that was the statement of financial position. The most important parts of this are the workings. Remember, the approach is start straight into your group workings, get them all done down to working 5. Don't close it off. Do your workings for the other notes. Then bring those adjustments into working 5 and do your statement of financial position. If you're running out of time, whatever note you've got to, finish there. Give yourself 2 minutes to pull your statement of financial position together. Do that and then move on. Do not overrun on time for this. you'll have picked up most of your marks in what you've done in the time available. If you go over your time, you are wasting time and wasting marks, and you're much less likely to pass.